The U.S. House of Representatives recently passed a significant fiscal policy dubbed the One Big Beautiful Bill, which extends the 2017 Trump-era tax cuts, increases military spending, and reduces welfare programs. The Congressional Budget Office projects that these tax provisions will increase the federal deficit by $3.8 trillion over the next decade, necessitating more borrowing and bond issuance. This development has already prompted Moody's to downgrade the U.S. credit rating from AAA to AA1, reflecting concerns about the country's ability to manage its burgeoning debt, which currently stands at $36.2 trillion. The U.S. debt-to-GDP ratio, a critical measure of national leverage, remains above 120% and is expected to continue rising. The bill's implications extend beyond U.S. borders, with potential ramifications for global markets, including emerging economies like India. Rising U.S. bond yields, driven by increased Treasury issuance and inflation concerns, could attract investors away from riskier emerging market assets, potentially leading to capital outflows. This scenario might pressure the Indian rupee and prompt intervention by the Reserve Bank of India to stabilize the currency. While the bill's increased spending is perceived positively by U.S. equity markets due to anticipated economic growth, its long-term fiscal sustainability remains a concern. Investors are advised to monitor bond markets closely, as shifts in U.S. fiscal policy could have widespread global financial repercussions.
The recent reinstatement of tariffs by a federal appeals court has significantly impacted the cost of hair products essential to many Black women in the United States. The tariffs, originally imposed by President Donald Trump, have raised the cost of synthetic and human hair, wigs, and styling tools imported primarily from China, which now faces a 30% tariff rate, down from a previous 145% following negotiations. These tariffs have exacerbated the financial strain on consumers and stylists, who are already grappling with inflation and rising costs in other areas. The Black hair care industry, valued at $3.2 billion in 2023, is particularly vulnerable as Black women spend disproportionately more on hair care compared to other ethnicities. The economic repercussions are visible in cities like Atlanta, where stylists report increased shipping costs and product shortages. Many are forced to raise prices or ask clients to provide their own hair, challenging the affordability for consumers who must choose between personal grooming and essential expenses. The situation has also pressured companies like Design Essentials to consider operational changes, such as delaying price hikes or reducing staff, to mitigate the impact on consumers. As the industry navigates these challenges, the broader economic implications of the tariffs remain uncertain, with potential long-term effects on consumer spending and business sustainability in the hair care sector.
Dangote Oil Refinery, a key player in Nigeria's energy sector, is set to import at least 5 million barrels of U.S. West Texas Intermediate (WTI) crude oil for July delivery. This move follows a potentially record-breaking intake of WTI in June, where the refinery secured approximately 300,000 barrels per day (BPD), marking the largest volume of WTI ever booked by the facility in a single month. The refinery, located in Lagos and boasting a 650,000 barrels of oil per day capacity, is increasingly reliant on foreign crude, supplementing its primarily Nigerian slate with imports to meet operational needs. Notably, Vital, SOCAR, and Glencore have been contracted to supply the July shipments, highlighting a strategic pivot towards diverse sourcing amidst evolving global market dynamics. The Dangote Refinery's increased procurement of U.S. crude, particularly WTI, underscores shifting trends in global oil markets. With Asian markets showing reduced demand due to competitive pricing of UAE's Murban crude, U.S. suppliers are turning to African buyers like Dangote as alternative outlets. This strategic move not only reflects the refinery's operational strategy, but also signals broader market shifts. The refinery's operational ramp-up, currently running at about 80% capacity and aiming for 85% by October, further emphasizes its growing role in regional energy supply. This development is significant for stakeholders monitoring global crude flows and regional energy dynamics, as it illustrates both the adaptability of the Dangote Refinery in leveraging global supply opportunities and the ongoing transformation of the African energy landscape.
Bulgaria is witnessing significant public dissent as nationalist groups and civic organizations protest the government's plans to adopt the euro currency. Thousands of Bulgarians rallied in Sofia and other cities, demanding a referendum on the euro adoption, a move that is expected to receive approval from Brussels shortly. The protesters, led by the pro-Russian Vazrajdan party, voiced concerns that switching from the Bulgarian lev to the euro could undermine national sovereignty and exacerbate economic challenges, such as inflation and reduced purchasing power. This sentiment reflects broader Euroscepticism in Bulgaria, one of the EU's poorest members, where years of political instability have fueled fears about deeper European integration. The protest highlights the geopolitical tensions influencing Bulgaria's economic decisions, as President Rumen Radev's call for a referendum was blocked by a pro-European parliamentary majority. This division underscores the complex interplay between domestic policy and external influences, particularly amid accusations that Radev's stance aligns with Russian interests. As Bulgaria stands on the cusp of joining the Eurozone, the outcome of this transition could significantly impact its economic trajectory, affecting everything from inflation rates to foreign investment and integration within the EU's economic framework. The situation remains a critical watchpoint for investors and policymakers monitoring the stability and economic policies of EU member states.
Everest Construction Group, Inc., NYSE ECG, is at the center of a securities class action lawsuit spearheaded by the Rosen law firm, a prominent global investor rights firm. The lawsuit targets investors who purchased Everest Construction stock between October 31, 2024 and February 11, 2025, including those who acquired shares as part of a spin-off from MDU Resources Group, Inc. The core allegation is that Everest made misleading statements regarding its business operations, notably underestimating the complexity and extended timeline of its project backlog, leading to delays in revenue recognition. As these issues came to light, investors reportedly incurred significant losses. The significance of this legal action is underscored by the June 3, 2025 deadline for affected investors to secure legal representation to potentially recover losses without upfront costs. The Rosen law firm, known for its track record in securities litigation, emphasizes the importance of selecting experienced counsel. The outcome of this case could influence Everest Construction's market perception and investor confidence, with broader implications for its stock performance and strategic operations moving forward. Investors are advised to consider their options carefully, including whether to serve as lead plaintiff or remain passive participants in the class action.
The main financial event currently impacting markets is President Donald Trump's decision to increase tariffs on foreign steel and aluminum imports to 50%. This move has raised concerns across various sectors, particularly in consumer goods, where the increased cost of metals used in packaging could lead to higher prices for everyday items. The Can Manufacturers Institute has voiced opposition, highlighting that these tariffs may result in increased costs for canned goods, thereby affecting American consumers directly. Economists are wary that such tariffs could stifle economic growth and lead to inflationary pressures, as businesses face uncertainty in planning and pricing. In parallel, China's manufacturing sector showed signs of resilience despite ongoing challenges. The country's Purchasing Managers' Index, PMI for May, indicated a contraction, but improved slightly from April, rising from 49.0 to 49.5. This improvement comes amid a new deal with the U.S. to reduce tariffs, suggesting potential stabilization in trade relations. However, key indices like new orders remain below the expansion threshold, indicating that recovery is still tentative. The developments in U.S.-China trade relations are crucial, as they can influence global supply chains and economic forecasts, potentially restoring some confidence in international markets. In other news, the FDA has approved a new lower-dose COVID-19 vaccine by Moderna, targeting adults 65 and older and those aged 12 to 64 at higher risk. This approval aligns with efforts to advance next-generation vaccines, potentially impacting public health strategies and vaccine distribution logistics. Meanwhile, Elon Musk's exit from his advisory role in President Trump's administration marks a significant shift as he returns to focus on his business ventures, including Tesla and SpaceX. Musk's departure follows a period of tumultuous engagement with political and economic policies, leaving behind a mixed legacy of attempted federal spending cuts and brand challenges.
The evolving dynamics between the United States and Canada signal a potential strategic shift in their historically cooperative relationship. Primarily influenced by recent U.S. political maneuvers, the U.S., under the current administration, has introduced reciprocal tariffs ostensibly to curb illegal immigration and fentanyl flow, actions which have raised economic and security concerns in Canada. These tariffs challenge the foundations of the USMCA, United States-Mexico-Canada Agreement, previously negotiated to facilitate trade among the three nations. The introduction of such tariffs could threaten Canada's economic stability, given its significant reliance on trade with the U.S., and has sparked fears of economic warfare, especially with rhetoric suggesting Canada could become the 51st U.S. state. Canada, in response, is considering strategies to diversify its economic dependencies and strengthen its sovereignty. This includes leveraging its vast reserves of critical minerals, fresh water, and strategic northern access. The shift in U.S. diplomacy has prompted Canada to reassess its trade relationships and national defense strategies, highlighting a need for resilience against potential economic aggression. The outcome of these developments could redefine the geopolitical landscape in North America, affecting trade flows, market strategies, and diplomatic relations, with potential long-term implications for both nations' economic policies and growth trajectories.
The recent passage of the One Big Beautiful Bill by the House has significant implications for green energy tax credits, which are crucial for homeowners considering energy-efficient upgrades. This bill, which aims to extend the tax provisions of the 2017 Tax Cuts and Jobs Act, also proposes to scale back many green energy tax incentives introduced or expanded under the 2022 Inflation Reduction Act. Notably, the bill seeks to repeal the Residential Clean Energy Property Credit and the Energy Efficient Home Improvement Credit for systems placed in service after 2025. These credits currently offer substantial tax benefits, such as a 30% credit on the cost of installing renewable energy systems like solar panels and specific home improvements. The Senate is now tasked with reviewing and potentially revising the bill, which could alter the fate of these credits. The Residential Clean Energy Property Credit, which has no maximum limit for solar, geothermal, wind, or battery storage systems, and the Energy Efficient Home Improvement Credit, with specific caps on various upgrades, are pivotal for homeowners looking to reduce energy costs and their tax liabilities. The potential rollback of these credits could impact market demand for renewable energy installations and energy-efficient home products, influencing both consumer behavior and the green energy sector. Homeowners are advised to complete any planned energy-saving upgrades by the end of 2025 to secure these benefits, amidst uncertainty over future legislative changes.
Robbins Geller Rudman and Dowd LLP has initiated a class action lawsuit against Organon and Company, alleging violations of the Securities Exchange Act of 1934. The lawsuit, Hausa v. Organon and Company, filed in New Jersey, targets Organon and certain executives for allegedly making misleading statements about the company's capital allocation priorities, particularly regarding its dividend payouts. The legal action claims that despite previously promoting dividends as a priority, Organon shifted its focus to debt reduction following its acquisition of Dermavant Sciences Limited. This strategic shift resulted in a drastic reduction of the quarterly dividend from 28 cents to 2 cents, announced on May 1, 2025, which coincided with a significant 27% drop in Organon's stock price. The lawsuit seeks to appoint a lead plaintiff by July 22, 2025, typically the investor with the largest financial interest, to represent the class in directing the lawsuit. Robbins Geller, known for its expertise in securities fraud litigation, emphasizes that participation in any potential recovery is not dependent on serving as the lead plaintiff. This case underscores the importance of transparency in corporate financial communications and highlights the potential impact of strategic shifts on investor trust and market valuation.
The 2025 South American Lithium Resources Field TRIP, organized by Shanghai Metals Market, SMM, underscores the strategic importance of South America's lithium triangle, comprising Bolivia, Argentina, and Chile, which holds over 55% of the world's proven lithium reserves. This initiative aims to explore the potential of lithium resources in supporting the global transition to a low-carbon economy. The field trip, led by SMM's project manager Chen Saiyu and senior analyst Zhou Jicheng, included visits to local enterprises and discussions with government bodies to assess opportunities for resource development, technological exchanges, and investment cooperation. The delegation's first visit was to NOAA Lithium Brines in Salta, Argentina, a key player in lithium exploration and development. NOAA has secured significant mining rights over 120,000 hectares, including major salt flats such as Rio Grande, Arizaro, and Salinas Grandes. Their recent mineral resource estimate for the Rio Grande project reveals a potential of 4.7 million metric tons of lithium carbonate equivalent, LCE, demonstrating substantial resource potential. This visit highlighted NOAA's sustainable exploration practices and potential collaboration with SMM to advance the lithium battery sector in South America. The second stop was the Undersecretariat of Mining Development in Argentina, led by Dr. Mario Arthime. This government body is instrumental in promoting mining investment through policies that attract both domestic and international investors, while emphasizing sustainable practices and legal compliance. The discussions provided insights into the market dynamics and challenges of the lithium battery industry, emphasizing Argentina's strategic role in the global lithium market. These initiatives are vital for sustaining Argentina's competitive edge and ensuring responsible development of its mineral resources.